Yields up, stocks down. Live from New York City this morning. Good morning, good morning. Your equity market on the S&P 500 negative here. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, the latest retail sales data coming in hot. China cutting interest rates by the most since 2020. As Yellen says the slowdown there poses risks here. We begin with the big issue, the consumer in America.
The U.S. consumer still remains extremely resilient.
The consumer is strong.
Very, very resilient.
Consumer sentiment is high.
Resilient consumer with their spending.
You're going to begin to see the impact on the consumer.
Demand cools just a bit.
The consumer starting to show some cracks.
Excess savings is starting to be exhausted.
Savings are being worked down.
Consumers are accelerating their borrowing.
There will be some headwinds.
Student loans.
The consumer is going to come under increasing pressure.
Inflation, food prices, oil prices.
There are a bunch of debts coming due.
Rates start to materially weigh on consumer activity.
It's how consumers behave, not what they say.
Retail sales surprising to the upside. Joining us now to discuss is BlackRock's Amanda Lynham, Morgan Stanley's Michael Kushner. Amanda, first to you. Bit of a sell-off again in the Treasury market. A 2-year briefly through 5%, a 10-year at about 4.23. Can we start with the data, Amanda? What did you make of that 30 minutes ago?
Yeah. Good morning, Jonathan. Thank you for having me. I think it kind of reinforces this resilient economic backdrop that we've been seeing for quite some time. And I think the major read-through for corporate credit investors is what does this mean for Fed policy and how long we stay in this restrictive territory? And so it's really less about what is the ultimate terminal rate, but more about does this resilient economic backdrop leave the Fed in a position where the bar for rate cuts is very high and they hold at this restrictive, tight monetary policy environment for a while. And that certainly has implications for the higher cost of capital environment that we've been expecting in the corporate credit market for some time.
Michael Kushner, let's build on that. What are the factors behind this resilient U.S. consumer? And are they expected to fade anytime soon?
Well, I think it still comes down to that underlying story that coming into the rate hiking cycle, the household sector in general had hunkered down with refinancing their mortgage rates to, probably well below 3% for many people, and corporate consumer cash flows are pretty good. Interest rates go up on savings and mortgage rates on liabilities don't go up, and you're aggregate okay. Of course, for certain sectors of the household sector who rent instead of buy, it's bad. And what's happened is not good for all households, but by and large, with nominal wage growth as fast as it is and increasingly real wage growth as inflation falls, the household sector, again, in aggregate, looks pretty solid. And even with savings diminishing, there's no real stresses on them yet. With the unemployment way it is, job growth is 200,000 approximately per month, which was the average was the previous decade before the pandemic. Why should the consumer be too stressed?
Let's build on this then, Amanda. Is good data bad news for credit based on what you said?
I think to a certain extent it can be if we have this environment where inflation is showing improvement, but the economy is still strong, unemployment is still low, the labor market in general is still pretty tight. I think it removes a sense of urgency for the Fed to normalize policy quickly, and that certainly will have implications for corporate credit. I mean, we're already seeing it now. I would point to the Moody's default data that we received overnight. We're seeing an ongoing dislocation between the leveraged loan default rate and the high yield bond default rate, meaning the leveraged loan default rate is outpacing and continues to outpace the high yield bond default rate. And it feeds into exactly what we've been discussing, which is this higher cost of capital environment. The only distinction really between the leveraged loan universe and the high yield bond universe as it relates to that point is that those higher costs of debt are flowing through immediately for loan borrowers, but it's taking some time for the high yield bond universe for that to flow through. So to your question, if we stay in this higher cost of capital environment over time and we move closer to those maturity walls, that will eventually flow through through. One of the questions we get asked a lot is, why is this not showing up in high yield spreads at the moment? And the reason is high yield borrowers, by and large, have the luxury of being patient at the moment. They've done so much refinancing, so much proactive liquidity raising in 2020 and 2021 that they don't need to act just yet. So they can still be patient, but it's only a matter of time before we get closer to that maturity wall, and I think that will flow through. Now, when you look at the corporate credit market, and Michael alluded to the dispersion that you're seeing at the consumer level, there's a lot of dispersion that's happening at the corporate credit level. So if you take that index level of 375 basis points of OAS in the high yield bond market, that in and of itself is tight. But if you look under the surface, half of that universe is actually trading below 300. So there's significant dispersion between the haves and the have-nots, and that's true within high yield, between high yield and loans. Certainly, as you get up into the investment grade landscape, it's a bit more resilient. But it's going to be a name of dispersion, I think, as we move through the next 12 to 18 months. And I think that will be key for corporate credit investors.
Amanda, could you frame for us just how painful that maturity wall might be? Let's pretend it's a month away. What's the difference between the coupon they're paying on existing debt and what they'd have to borrow at today?
Yeah, it's a great question. So I think the most instructive way to conceptualize that is to look at some of the sectors. At the index level, that differential is around 200 basis points. But for certain sectors, it's upwards of 300, 400 basis points or more. Now, we know that in practice, sectors don't issue debt, companies issue debt. But for some of those sectors that are facing, I would say, a combination of limited pricing power, secular headwinds, ongoing idiosyncratic risks, those mark-to-markets in the cost of debt will be significant. Now, corporates can offset that to some degree. They can issue less size. They could be strategic about parts of the curve that they target. They can try to be as opportunistic as they can about timing. But we do think that as that maturity wall moves closer, it will become a major story for corporate credit investors. And I think importantly, it's not just the 2025 maturity wall. It actually doesn't let up until 2029 in the U.S. high yield bond market. So there's a significant quantum of debt that needs to be refinanced. And of course, we're coming off of record low supply years in 2022 and so far year to date, and record low coupons owing, of course, to the activity of 2020 and 2021.
And Michael, what's interesting about what Amanda just said is so much of this is known to some extent. We have some insight, some clarity on this. We know where the maturity wall is. What I'm trying to understand, Michael, is when do we start to worry about it?
I think it's by the middle of next year. By the middle of next year, we should see, for sure, a slowdown in the economy and the Fed able to bring down interest rates and maybe bring down the whole term structure of interest rates. But if some things have changed so fundamentally that real interest rates, the final term interest rate the Fed's talking about, I think one of the big risks for the Fed in the second half or the fourth quarter of the year is that they don't change monetary policy, but they say actually that 2.5%, final terminal Fed funds rate, maybe it's 3.5%, and the rate cuts you can expect are much lower because the demand for capital, the underlying strength in the economy is strong enough to generate that strong growth, and it may be very uneven in who benefits and who loses from that. So by next year, we should see in terms of who's benefiting, who's losing, and how much the Fed will give relief to what's going on. That'll depend critically on the inflation rate and to a lesser degree on the unemployment rate.
Amanda, is that the source of comfort right now, that this is a problem out there in the distance, and before we get there, the Fed's going to be cutting rates?
As you know, Jonathan, we think the bar for rate cuts is very high. So I don't think that near-term rate cuts in the U.S. are a likely outcome from here. Taking your question specifically on timing, if we just look at the math of it, the 2025 maturity wall is really what we're focusing on in terms of the beginning of those refinancing needs. We know that high-yield corporates in particular don't like to let their debt become current. So it's reasonable to think that they will start to address that 12 months or more before those maturity dates to avoid that situation. So I don't think it's that far off in the distance. I think really what this hinges on is the unemployment rate, the backdrop of economic resilience, and is there urgency from monetary policy officials to normalize rates? I think, we'll look towards the Jackson Hole Symposium for color on kind of the duration of how long we stay in this restrictive territory. But I don't think, and this is very consistent with our colleagues in the BlackRock Investment Institute that the Fed in particular is coming to the rescue anytime soon from this higher cost of capital environment.
Equities this morning, 20 minutes out from the opening bow, down here by 0.6% on the S&P 500. In the bond market, retail sales pretty strong relative to expectations. Yields were higher through 5% at the front end on a 2-year. Backed away since then, down about 2 basis points on a session now to about 4.95 on a 10-year. They were much higher through 4.23, 4.26 briefly. Back down just sub 4.20 at the moment at 4.19.92. Joining us now is Bloomberg's Ira Jersey to break down the data from about 40 minutes ago. Ira, what did you make of that?
Yeah, so clearly the consumer is pretty strong. They like lower prices. Like, we have to remember that even though inflation, and based on the CPI report that we received last week, it was generally still not in the Fed's comfort zone, goods prices were actually a little bit lower. So I think it just shows a propensity of the consumer to continue to purchase goods when goods prices aren't going up significantly. So I do think the data is better. I think that the big thing that we have to take away from this from a monetary policy perspective is not does the Fed necessarily hike more, but how long do they keep interest rates where they are now? So if the market starts to price out some of the cuts from that are being priced for next year, that's as good as a hike in terms of financial conditions.
We've said it a few times. It's not just how high, it's how long. Ira, thank you, sir. Michael Kushner, Amanda mentioned the Fed and Jackson Hole next week. We're expecting to hear from Chairman Powell. Michael, what would you expect to hear from him?
I think it's a bit complicated at the moment. We know the FOMC is a bit conflicted in terms of what they think we should do. Some members think we should hike rates further. Other things, we've done enough. We have to wait and see. Others think maybe we should have rate cuts if inflation continues to fall to keep real rates where they are. So we got 3 different kind of views, at least, amongst the board. So we'll have to wait and see how that plays out. So I don't think Chairman Powell can deviate from the current situation where we're waiting for more data. We're data dependent, and there's nothing else that we can say at the moment until we get more data.
Michael Kushner, Amanda Lynham on the latest with the Federal Reserve and the latest on the data as well. They're going to stick with us. Equity futures right now on the S&P 500 negative here by, let's call it 0.5%, with some movers around the opening bell about 20 minutes away. Here's Abby.
And a bit of a risk-off mood as you're talking about, John, but one big cap tech stock that is super resilient, NVIDIA, after rallying 7% yesterday, and Morgan Stanley saying that the recent, and in my mind, stealth 15% drop from the July top offers an attractive point of entry, and I should say recent top. Who knows, there could be another one. B of A filing today, boosting their price target. They report, of course, next week. The stock up another 2%. JP Morgan down 1.4%, falling amid this risk-off mood. Plus, there's some continued chatter about banks getting downgraded. Even the best of the best is feeling that pinch today. And then Tesla, well off of its lows earlier, down more than 1%, now down about 0.5% after they have rolled out a new base model X and S, but with a price tag that is $10,000 cheaper. Speaking of being off the recent high, Tesla off 22% off of its July high, John.
Abby, thank you. On the latest, more on Tesla with Ed Ludlow in about 20 minutes from now. Coming up, China's surprise rate cut.
We're going to need to see considerably more across different areas of policy for China in order to really give this recovery firm footing. There is such an accumulation of different problems and challenges facing China's economy. It's not just one thing right now.
That conversation up next.
We're going to need to see considerably more across different areas of policy for China in order to really give this recovery firm footing. We'll need to see more coming on fiscal, given an absence of demand coming from other parts of the economy. I think we'll need to see more measures to stabilize property, given the latest warning signs there. And we'll need to see more follow through on these initial efforts to boost longer-term confidence.
Michael Hirschen there of 22V Research weighing in on China's surprising rate cut. The BPOC unexpectedly cutting rates by the most since 2020 in hopes of bolstering an economy that's facing fresh headwinds from a worsening property slump and weakening consumer spending. Secretary Yellen acknowledging the risk of contagion, saying this: China's slowdown will have the largest impact on its Asian neighbours, but there will be some spillovers to the United States. The team coverage begins right now with Bloomberg's Katie Nines and Tom Orlick joining us down in DC. Tom, just how bad are things down in China, and what can they do about it?
So what we've got right now, Jonathan, is a crystallization of risks for the Chinese economy. The property sector was already turning down, but repeated efforts by the government to put a floor under that downturn don't seem to have gained any traction. And now we have Country Garden, one of China's biggest private developers, apparently on the cusp of not being able to service its debts. Worse news, signs that slump in the real estate sector are now spilling over into the financial sector, with one of China's biggest trust companies, one of China's biggest shadow banks, struggling to make its investors whole. All of that reflected in the July growth data, with industrial output, retail sales, fixed asset investment, all the big gauges of China's growth, missing expectations and pointing to a bleak second half. Well, the cavalry's on the way, but hasn't quite arrived yet. People's Bank of China cut interest rates by 15 basis points. Normally they move in 10 basis point increments, so 15 basis points is a signal, and there's a bit more oomph there than normal. Still, relative to the magnitude of the challenge which China is facing, and also relative to the enormous interest rate moves which we've seen from the Fed and the ECB and others as they battle inflation, 15 basis points really looks inadequate to the scale of the challenge. Expect substantially more stimulus from China in the days and weeks ahead as they attempt to put a floor under growth.
You're not alone. I've heard that plenty of times this morning already across the South Side. SocGen said this is unlikely to be the last measure. Katie, we actually heard from the Treasury Secretary acknowledging that this could be bad news for the US. To what extent could that be bad news?
Well, she did try to downplay this while acknowledging the risks, Jonathan. She said that she still feels good about U.S. economic prospects overall, while recognizing that China does indeed pose a risk factor. Of course, as the Treasury Secretary, former Federal Reserve Chair, she is not immune to the knowledge that anything that happens in the second largest economy and fragilities in it could have ripple effects around the rest of the world. She was, though, more careful in the selection of her words than, say, President Joe Biden last week, who at a donor event in Utah called the Chinese economy a ticking time bomb and said that they were in, quote, trouble. And that trouble is feeding through to the U.S. policy response to China as well. Of course, we've heard repeatedly from not just Secretary Yellen, but others in the administration saying that they are not intending to hold China back economically with some of their policies or decouple these two largest economies in the world, rather using narrow, specific targeted things to protect national security interests, like that narrow in scope outbound executive order related to outbound investment into China last week. It's a very difficult needle to thread, not just geopolitically, as this administration is also trying to improve relations with Beijing, but economically as well, given the risks of spillover. We heard the Treasury Secretary acknowledging yesterday. John.
Katie, Tom, to the both of you, thank you. For a final word, Amanda and Michael back with us. Amanda, just a word on China. The financial stress that is emerging, the economic slowdown, how concerned should we be stateside, both from an economics perspective and a markets perspective as well?
Sure. I mean, I think from a risk sentiment perspective, it's a key factor to watch. I think really for investors, the critical point will be, does the contagion spread? And so as we know, the high yield property market in China has been under pressure for quite some time. We're seeing high double-digit default rates already year to date. So to some extent, that's a known risk. I think how much that extends both within the Chinese market and then if it does extend more broadly globally is a key impact. Probably in the near term, the focus for investors will be on dispersion. So are there sectors, are there companies that are reliant upon China for that next leg of incremental growth? What does that mean for the cyclical momentum behind those sectors and firms? And I think that's probably in the near term, absent future developments, what we should be watching.
Michael Kushma, final word, please.
Agree with that. I think in addition, many of our large trading partners in Europe have been highly dependent on Chinese growth for exports to China. And that we know Europe, for example, is struggling quite mightily right now across the board, and continued weakness in the Chinese economy can't be good for them, which then feeds through to the U.S., which are very large trading partners with the United States. And the U.S. trade deficit could easily get larger, subtracting from growth as import growth remains strong because of demand from the United States consumer. On the other hand, demand from outside the United States for U.S. products diminishes, which will detract from growth going forward, which again is not great.
Michael Kushner, Amanda Lynham, to the two of you, thank you. Plenty to talk about today. The US consumer, retail sales, plenty of earnings later on in the week as well. We'll hear from Walmart on Thursday. You'll hear from Target tomorrow, and plenty to talk about over in China as well. Disappointing growth all year, just not where we thought we would be. Relative to the hopes and dreams of the China reopening story at the start of the year, those faded and faded fast. Your equity market right now negative by 0.4% on the S&P, but slowly recovering as we inch towards the opening bell. In the bond market, that moves fades as well. Earlier this morning, that real sell-off continued. Yields higher, just about unchanged now on a 10-year, in and around 420. Coming up, the morning calls and later, Tony Dwyer of Canaccord joins us around the opening bell, recommending investors stay patient until there's a clearer outlook for rates and the Fed. That conversation just around the corner. Five minutes away from the opening bell, equity futures down across the board here on the S&P 500, negative by 0.4%. That's the price action. Let's get used to morning calls. First up, UBS raising its NVIDIA price target to 540, expecting shares to rebound on the back of next week's earnings report. That stock is up by 2%. B of A downgrading Valero to neutral, saying energy stocks could move sideways after their recent outperformance. We're down there by a little more than 2%. And finally, Evercore adding Discovery Financial to their tactical underperform list, seeing limited upside after the company's CEO abruptly stepped down. That stock is down by almost 9%. Coming up, stay patient until the clouds start clearing. That's the recommendation from Tony Dwyer of Canaccord. What he needs to see to start being bullish on stocks once again. That conversation coming up shortly. Your opening bell just around the corner. 24 seconds away from the opening bell here. We're negative across the board as we have been all morning. S&P 500 futures negative 0.4%. On the Nasdaq 100 down by about a third, but improving as we get closer and closer to the opening bell in the United States. There's your opening bell in the States. Switch to the board and get to the bond market. Yields look like this on a 10-year, 419.92. Yields up by not even a basis point this morning. In the FX market, a break of 109 briefly, 109.41 right here, positive by a third of 1% on that currency pair. Let's get to one stock to watch at the open. It's Home Depot, the company topping earnings estimates, but starting to see signs of a pullback from consumers. The CEO writing, quote, while there was strength in categories associated with smaller projects, we did see continued pressure in certain big ticket items. Abigail Doolittle has more. Hey, Abby.
Hey, John. Well, lots of nuances in this quarter, indeed. So on the surface level, as you mentioned, they beat, and they also beat in an important category of same-store sales, because they've actually had, over the last 2 quarters, declining same-store sales. The last quarter was down 4.5%. Well, this one came in down 2%, beating the estimate. So there is a positive there. They also beat the earnings and the revenue estimate. So again, positives. But yes, we do have that color from management that bigger ticket items, they're not really selling. On the other hand, the average ticket price did rise, suggesting that they are continuing to they're able to hold higher prices. Another nuance, though, the continued deflation of lumber and other items. If you recall, they actually lowered the full year guidance back in May. So that could weigh on other quarters. And they stuck with that lowered guidance. They didn't raise it despite the beat. That suggests that they're either trying to build a cushion for later this year, or they do, in fact, see weakness ahead. As for the stock, it had been earlier in the pre-market, now up about 0.7%, rewarding the company a little bit here. But on a bigger picture, John, this stock has essentially been stuck in a range between, let's call it 300 and 320, 340, somewhere in that range. They're probably going to have to put up better results than this to pop out of that range.
334 right now. Abby, thank you. Let's turn to the auto sector. Tesla shares under pressure after rolling out cheaper versions of the Model S and Model X. It's the company's second move in as many days to lower prices after offering fresh discounts throughout China just yesterday. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. Tesla actually just turning a corner, up 0.2%. It had been lower immediately following the open, basically flat now. Base models or new base models for the Model S and Model X are $10,000 cheaper than the prior generation. They have lower range. Remember, this is a low volume production vehicle. For Tesla, the S and X accounted for about 3.4% of overall deliveries in the first half of this year. But it does come 24 hours after you and I discussed Tesla cutting prices in China on the two variants of the Model Y, the long range and the performance, both cut by around $1,900 US. Tesla's not been afraid to use the lever of price cuts or introducing a new lower spec base model of these two S and X in a way to find new pockets of demand. And, you know, you and I have discussed this so many times that Musk and other Tesla executives are very clear that they are willing to sacrifice the bottom line and the impact to margins in order to protect that overall target growth rate of 50% annually. And this is another good example of that. But again, a lower volume production, and we're flat on the stock, Jonathan. It's a stock that's up 94% year to date.
Totally unchanged. Ed, thanks for the update. Thank you, sir. Let's take it to the housing market. Warren Buffett's Berkshire Hathaway unveiling a big bet on US home builders. The company disclosing new positions in D.R. Horton, NVR and Lennar, together worth more than $800 million US. This according to their most recent 13F filings. Katie Greifeld has the story. Hey, Katie.
Hey, John. Yeah, home builders certainly rallying today following that vote of confidence from Berkshire Hathaway. We're talking about D.R. Horton, Lennar, and NVR. Those positions were added in the second quarter. And of course, those stocks have been on a tear all year, given that big demand for houses has been met with a severe shortage of existing homes for sales. Now, in addition to these new positions, Evercore analyst Stephen Kim points out that Berkshire Hathaway already owns stakes in private home builders through Clayton Properties Group. So these new positions deepen that bet. And this was interesting, John. Evercore's Kim wrote that Berkshire's investment could help highlight, quote, the home builders' strong cash flows, healthy balance sheets, and favorable industry backdrop to a broader audience than the builder stocks have historically attracted. And you can see they're certainly seeing that love this morning.
Hey, Katie, thank you. Taking advantage of a frozen property market. The people with 2% mortgages don't want to move, and the people facing 8% mortgages can't really buy. Finally, hedge funds putting their faith in big tech and AI-related stocks. Institutional investors loading up on shares of Meta, Microsoft and Apple in the second quarter. Tech stocks accounting for the biggest weighting in the group's portfolios at 28%. Shanali Basak has more. Hey, Shanali.
Hey, John, if you think about the tech buying you saw during the second quarter, perhaps not surprising given what you saw in the moves in the NASDAQ, but you do have to take a look at exactly what people were buying. If you looked at the top 5 holdings, it actually wasn't all big tech. A lot of it was Amazon, one of the top 5 holdings. And outside of that, in the top 5 holdings, you had buying of the iShares U.S. Treasury Bond ETF as the top buy for the quarter, as well as iShares Core Total U.S. Bond Market ETF being the third. So bonds being 2 of the 3 biggest equity buys in the ETF land when you look at what funds were buying. Now, we also have to talk about the movement we saw during the quarter, because hedge funds, as we know, are not static. 13Fs go through the end of the second quarter, and it has been weeks since then. So it is just as important to look at what people were selling as it was what people were buying. And you did see some of the biggest tiger cubs in the hedge fund land sit sit and start to pare their stakes in some of the biggest holdings. You also saw some of the biggest billionaire family offices also pare their stakes in massive tech names. Soros Fund Management exiting, Alibaba exiting, Alphabet, Stan Druckenmiller's Duquesne also exiting the likes of Alphabet and AMD. So you did see some selling, but again, people were nipping back in the market at the margins here during a very healthy moment in the markets.
Shonali, you know it's that time of the year. We asked the same question. How useful are 13F filings?
Not very, because they are old. However, the direction of travel is important to watch here. In addition to the 13F filings, we had also recently, for example, John, gotten a note from Goldman's Prime Brokerage that is putting out their outlook for the rest of the year. And it says a lot of what we see in the 13Fs, where it's credit, it is bonds, it is not equities. That is the biggest question and the biggest kind of point of excitement here for the biggest investors.
Shonali, thank you for the update. We're about 6 or 7 minutes into the session. Equities are lower here by 0.4%. Not quite as bad as it looked earlier on this morning. Similar story in the Treasury market. Yields were much higher, now higher by just a couple of basis points, the 10-year at about 4.21. Tony Dwyer of Canaccord recommending equity investors stay patient, writing this: the time to be bullish maybe when bad news becomes bad news. The better economic performance reinforces a recession over the coming quarters because it keeps the Fed's rates higher for longer. Historically, the catalyst for forward growth is a much more favourable outlook for money that only comes with a rapid drop in rates. Wait for the clouds to clear. Tony, I'm pleased to say, joins us right now. Tony, is that another way of saying this soft landing talk is also bad news?
So, John, I've been kind of public with, I think the soft landing scenario is the worst case scenario. And the reason is because it keeps rates higher for longer. When you're in a generationally levered system on debt to GDP, the longer that you keep rates elevated, the more interest expense you're going to have over time. For example, let's just think of common sense, for the viewers and the listeners. How many people have you heard get loans in the last 3 years where there was no interest payment for a year? So all of a sudden you fast forward and your interest payments could potentially be a lot higher. And I think ultimately that's why people, like you said, are stuck in their house. Mortgage rates. Listen, you need an improved outlook for money. When I look at the soft landings of 1995 or 1966, in both of those cases, you had a 200 basis point drop in short rates. We have government interest rates at the same level as a year ago. Corporate interest rates at the same level as a year ago, mortgage interest rates at the same level as a year ago. So let's even assume a soft landing can magically happen. What's your next catalyst for double-digit earnings this upcoming year? And I know people would say, well, productivity, and certainly that could help, but you really need a revenue pump. And I don't know how you're going to do that with money where it is.
Tony, these issues around rates, do they speak to the recent developments in the bond market? I've asked this question a few times over the last week. Just what is the dominant factor underpinning this bond market move, with yields back up to about 4.20 on a 10-year and close to 5% on a 2-year?
Well, I got to say, it happened right after Janet Yellen announced an increase of 1/3 in Treasury new issuance. I mean, you're financing paper now at over 5%, no matter where you are on the curve. That was zero. It was 0.5%. So the issue that we have here is, for a generation, the refi cycle is probably broken, because I look at my own household. I have a 2 7/8 mortgage. For me to be able to refinance that mortgage and take money out and do it affordably with anywhere near the same monthly payment, you're going to have to get the 10-year back down toward 1%. And imagine what the employment picture would look like if that's the case. So, there are some offsetting positives. This is, sounds Armageddon negative. The offsetting positives can be that private credit is kind of stepping up into a place where the bank credit is falling.
Listen to you, Tony, showing off. I've got a 2 handle on my mortgage. Tony, that's like saying you've got a Lamborghini on the drive in 2023.
But I'm pretty good at being wrong in the stock market, but my mortgage trades have been
Tony, you're kidding me. I wish I had a mortgage with a 2 handle, locked in for 30 years. Tony, I've had a lot of people tell me that we can't sustain life above 4% on a 10-year, that this isn't sustainable. Do you endorse that view?
I don't think it's sustainable. John, for example, this morning, I have this great research assistant. His name is Google. So I just Googled, strong retail sales, and better than expected prior to recession. I went back and I looked at 2007. In November 2007, you had a huge move up in retail sales, and the reason was better than expected income growth and full employment. better consumer confidence. So, all you have to do, I believe, in this thing is try to maintain patience. And what we're going to do all day, unfortunately, you have to do it and I have to do it. We have to comment on what the stock market's doing in this half hour. And what we found over the course of this year, last year, and the year before is that intraday volatility has become so extreme. I think that information is useless. What is useful is where are we with employment, and that's been pretty good. And where are we with interest rates, and that's not so good. So ultimately, when the higher interest rates, if they stay higher for longer, do bite into the interest expense and companies have to pull back a little bit, that's when the unemployment picture starts to rise. That's when bad news becomes bad news, and that's when I want to attack. The time to be seriously negative, in my view, was last August. And man, did I feel dumb last August. Market was ripping. And as you remember, I'm sure you remember, I was pretty negative, feeling really wrong. And then we went into the October swoon as rates started to really ramp. Now, I believe, is the time as stocks pull back, John, to try to take advantage when bad news becomes bad news, because that's when the outlook for money improves as the Fed cuts rates.
Tony, do you feel a repeat of that late summer story coming into September last year?
I think you got a buffer, John, and I think part of it is, like, for example, 3 or 4 months ago, nobody in China was talking about a 100 basis point rate cut. So, things change fast when unemployment starts going up because it becomes a political influence. So, yeah, I do think we can have a sharp sell-off. I don't think we're probably going to go back to the October lows. You don't need to. I think a good enough sharp sell-off that really comes from worse economic data and the employment picture that helps the Fed really in expectations for Fed rate cuts have the 6-month, the 2-year come down hard. I mean, think about this, John. You and Lisa earlier this morning did a great job of talking about mortgage paper. So we're at a 7.25 on a 30-year fixed conventional mortgage. That comes because there's a historic spread, wide spread between 10-year treasuries and mortgages. If you have the Fed cut 100 basis points, and if you have that spread go back to a more normal level, if you stop QT or at least pause it, then all of a sudden you got a 200 basis point drop in mortgage rates. And when that happens, you can really kickstart maybe the next economic cycle. I don't know how you're going to magically do it without a real drop in rates.
Tony Dwyer, Chief Market Strategist at Canaccord and owner of a 2% mortgage. Tony, thank you, sir.
2 7/8, buddy. 2
7/8.
Just very close to.
I'm making it sound even better for you, Tony. Go away. Tony, thank you. I'm so jealous, honestly. The mortgage envy is real. Your equity market on the S&P 500, slightly negative this morning. Coming up, Secretary Yellen leading the Bidenomics PR tour.
The administration remains committed to taking actions to lower prices for Americans where we can.
That conversation coming up shortly.
The administration remains committed to taking actions to lower prices for Americans where we can. And we continue to monitor developments, particularly those abroad, that may affect prices and growth.
Secretary Yellen praising the president's economic policies in Las Vegas. The administration celebrating the 1-year anniversary of the Inflation Reduction Act, with Vice President Kamala Harris speaking in Seattle, President Biden addressing voters in Milwaukee at 2 p.m. Eastern. This all ahead of his big speech Wednesday from the White House. The president trying to ramp up voter support as presidential candidate Donald Trump gets indicted in Atlanta over efforts to overturn the results of the election defeat in Georgia.
The indictment alleges that rather than abide by Georgia's legal process for election challenges, the defendants engaged in a criminal racketeering enterprise to overturn Georgia's presidential election result.
Let's get to the Bloomberg team. Kelly Lyons and Mario Parker joining us down in Washington, D.C. Mario, first to you. What's the latest, please?
Well, the framing that you had in your introduction, Jonathan, I think was spot on, right? You got President Biden going to Milwaukee, a city and a key swing state, to tout his economic agenda ahead of the 2024 election. And you've got former President Donald Trump down in Georgia, another key state, with the latest indictment. one thing to be sure about with former President Donald Trump and how he's using these indictments to try to capitalize and fuel his political comeback is that they're indistinguishable at this point from his campaign.
Katie, is this just drowning out the campaigning of President Biden on his Bidenomics tour, or is it helping him?
Well, it's hard to compete with the headlines, right, John, as so much media attention has been placed on the legal woes of the former president. But the current president is trying his very best, not just him, but others in the administration, other surrogates on this 10-state swing this week to celebrate the one-year anniversary of the Inflation Reduction Act. As you pointed out, there will be an event at the White House tomorrow. But before that, today, the president will be in Milwaukee, Wisconsin with this message. It's important to note the significance of that location choice as well. Wisconsin, of course, is a critical swing state. He won it by a narrow margin over Trump in the 2020 election. And the city of Milwaukee is also the location of the first Republican primary debate that is taking place next week. Now, as for whether or not this messaging really is going to resonate to this point, despite what the president has touted as growth in the economy from the middle out and bottom up, it isn't necessarily showing in the polling. Still, a majority of Americans disapprove of his handling on the economy. That is consistently shown in surveys. His approval rating also remains low overall. And so that is what this tour really is intended to rectify. But definitely some oxygen being sucked out of the room by his likely opponent in a general election if the current stance of the race holds
Mario,
as it is now, John.
Can you jump in and translate this for me, this headline that crossed from CNN just moments ago, that Hunter Biden's top lawyer has asked to withdraw from the case? What does that mean, Mario?
Well, it means that now we've got the former president kind of dogged by investigations, and it looks like the White House, much to its chagrin, from where they were thinking things would be at least 2 weeks ago, will also have an investigation kind of hovering over the 2024 election as well. This isn't great news for the president. I mean, Republicans, going back to the 2020 cycle, have tried to make his son, Hunter Biden, a focus of their attacks. And it's a weak spot for the president going into 2024. It allows Republicans to engage in whataboutism, as to Kaylee's point, as former President Donald Trump is embroiled in his own investigations.
That headline just crossed in moments ago. Mario, Kaylee, to the two of you, thank you. Just to share that with you again from CNN, Hunter Biden's top lawyer asking to withdraw from the case. Plenty more on that, of course, on Balance of Power a little bit later at 5 p.m. Eastern Time with Katie Lyons and Joe Matthew today. I'm told that Anne-Marie's going to be back tomorrow. About 21 minutes into the session, we're down by 0.6% on the S&P 500 with a sector price action. Here's Abby.
And with that sort of decline, John, we are looking at all 11 S&P 500 sectors lower today, led by energy down 2.1%. We also have materials, financials down on the bottom, down more than 1%, joined by utilities up top. Interestingly, technology down just 0.1% or thereabouts. However, on the month, it's a different story. So the month of August for the S&P 500, we're looking at a greater than 2% decline. That's the worst month of the year. And this is one of the worst sectors. Technology down 5.4%. Earlier, I was talking about those stealth sell-offs for Tesla, or at least the degree of them, and NVIDIA. Well, this index is also heading to its worst month right now since December of last year, John.
It's had a tough go of it over the last few weeks, that's for sure. Abby, thank you. Coming up on this programme, your trading diary. 25 minutes into the session. It's certainly not as bad as it looked earlier on this morning off the back of more weak data from China and a rate cut in the mix as well. We're down about 0.6% on the S&P 500. Not as bad as it was, because it's not as bad as it was in the bond market too. If you switch on the board and get to the bond market, yields are right off the highs of today, with a 10-year yield right now at about 4.1757. A 2-year, that yield's declining now to about 4.92. Only an hour and 30 minutes ago, that was through 5%. Very, very briefly. Since then, we've backed away anyway. So that sell-off in the bond market slowly getting bought in the last 30 minutes or so. As the price action, here's the trading diary. Coming up, the Fed speak from Neil Kashkari of the Minneapolis Fed. That will take place at 11 a.m. Eastern Time. President Biden discussing the U.S. economy from Milwaukee at 2 p.m. this afternoon. Then delivering remarks on the Inflation Reduction Act from the White House tomorrow. Plus tomorrow, Target earnings before the opening bell. And in the afternoon, some Fed minutes in the mix as well. Walmart numbers and another round of jobless claims. They come on Thursday. And finally, we round out the week on Friday with Eurozone CPI. That rounds out the morning for me. Thank you for choosing Bloomberg TV and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.